Imagine a market so large, so powerful, that its slightest whisper can send stock markets plunging, erase trillions in wealth overnight, and force entire nations to change course. This isn't the plot of a financial thriller. This is the $50 trillion U.S. Treasury bond market. While your eyes are glued to the flashy red and green of stock tickers, the real puppet master operates in silence, trading in bonds. A single decimal point move in its yield can dictate whether you get a mortgage, whether your retirement account grows, and whether a country faces a recession. This is the story of the greatest, most misunderstood force in global finance. Let's start with the basics. A bond is simply an IOU. When you buy a U.S. Treasury bond, you're lending money to the U.S. government. In return, they promise to pay you a fixed interest payment called the coupon and return your principal on a specific future date. But here's where it gets interesting. After issuance, bonds are traded on the open market. Their price fluctuates based on demand. And this is the golden rule. Bond prices and yields move in opposite directions. Think of a seesaw. When the price of a bond goes up, its yield goes down. Why? Because the fixed coupon payment represents a smaller percentage return on your now higher investment price. Conversely, if panic hits and everyone sells, the bond's price crashes, but its yield skyrockets. This yield isn't just a number. It's the risk-free rate, the foundational benchmark for the entire $100+ trillion global financial system. Why risk-free? Because the U.S. government can always print dollars to pay its debts, making default virtually impossible. This yield is the baseline return investors demand for parting with their money for 2, 10, or 30 years. Every other investment, stocks, corporate bonds, real estate, even crypto, is priced relative to this baseline. If you can get a safe 5% from the government, why would you accept a risky 6% from a shaky corporation? This simple comparison sets the price of risk worldwide. This is the kill switch. For stocks, especially the high-flying tech giants, the risk-free yield is the anchor in a crucial valuation model called discounted cash flow. It works like this. A company's value today is the sum of all the money it's expected to make in the future, discounted back to the present. That discount rate is heavily influenced by the Treasury yield. When yields rise, the discount rate rises. Future profits become worth less in today's dollars. The math turns brutal. A stock valued on profits expected a decade from now can see its theoretical worth evaporate by 30%, 40%, or more, with just a 1% rise in long-term yields. This isn't theory. This is what crushed the NASDAQ in 2022. Bonds are also the market's crystal ball for inflation. The standard 10-year Treasury yield is essentially the market's collective forecast for average inflation over the next decade, plus a little extra for the risk of lending. If investors believe the Federal Reserve will lose control and inflation will run hot at 4% for years, they will demand a much higher yield to compensate for their money being eroded. Conversely, if a recession looms, yields fall as investors seek safety and bet on disinflation. In 2021, surging bond yields were the first major warning sign that the transitory inflation narrative was wrong, months before stocks began their painful correction. The yield curve is the bond market's secret language, and its shape tells a profound story. A normal curve slopes upward. Long-term bonds have higher yields than short-term ones, reflecting the risk of lending for longer. A flat curve suggests uncertainty about future growth. An inverted curve, where short-term yields are higher than long-term yields, is the most feared signal. It suggests investors expect economic trouble ahead, prompting the Fed to cut rates soon. This inversion has preceded every U.S. recession for the past 50 years. It flashed red in 2022 and 2023, and the message was clear: Economic contraction was on the horizon. The Federal Reserve doesn't just set short-term rates. Through quantitative tightening, or QT, it directly manipulates the long end of the yield curve. After buying trillions in bonds to suppress yields during crises, the Fed is now doing the opposite. It's letting bonds roll off its balance sheet without reinvestment, effectively dumping supply into the market. This increases the available bonds, pushing prices down and yields up. It's a deliberate, powerful tool to tighten financial conditions, cool the economy, and fight inflation by making borrowing more expensive for everyone, from the government to homebuyers. The U.S. bond market is a global beast. Foreign governments, especially Japan and China, hold trillions in U.S. treasuries as safe reserves. Their demand is a massive force. When they buy, yields stay lower. But what happens if they stop buying, or worse, start selling? If Japan, facing its own inflation, needs to defend the yen, it might sell U.S. treasuries to buy yen. This selling pushes U.S. yields higher, which in turn strengthens the dollar further, a vicious cycle. This global interdependence means a pension fund in Tokyo can directly impact mortgage rates in Ohio. So what's the forecast for 2025? Multiple forces are aligning to put upward pressure on yields. Persistent inflation may force the Fed to keep rates higher for longer or even restart hiking. Massive U.S. government deficit spending requiring constant new bond issuance floods the market with supply. A potential global shift away from the dollar could reduce foreign demand. If the 10-year yield breaks decisively above previous highs, it could trigger the next leg down in overvalued stock markets, cause a commercial real estate crisis as refinancing becomes impossible, and test the stability of the entire financial system. The calm of 2024 could be the eye of the storm. In the universe of finance, bond yields are the force of gravity. They are invisible, constant, and ultimately inescapable. Ignoring their pull because stocks seem exciting is like building a castle on sand as the tide comes in. For the savvy investor, the bond market isn't a boring alternative. It's the primary source of intelligence. Its movements telegraph the future of inflation, growth, and policy. In 2025, as trillions in debt need refinancing and governments grapple with their budgets, understanding this silent $50 trillion market isn't just smart. It's essential for survival. The yield is the message. Your job is to listen.